Hey guys, and welcome back to Millennial Investing. In today's video, we're going to talk about how to invest your first $1,000. This is a video geared towards newbies, beginners to the stock market, real estate investing, personal finance, but it is also a kind of a let's reassess our conviction and talk about some of the basics if you are a seasoned investor. So don't click away if you kind of know what you're doing or you've already kind of gotten your feet into the water. We're going to talk about all things investing in today's video. And again, if you have to invest your first $1,000, I'm going to tell you how to get started, what your options are, and basically the basics of what you need to know. If you aren't already subscribed to the video or you enjoy this content, please consider subscribing and liking the video in the comment section below. I'm never going to sell you anything. This is just an education channel where I provide as much free content and knowledge as I can to hopefully allow you guys to retire just a little bit earlier in your journey through life. So what is investing? Let's go down to the basics. Investing is putting your money or your time, but particularly in this instance, your money, into a vehicle that is going to make you more money, right? It's getting your army of dollar bills. If you know where that's from, let me know in the comment section below. It's getting your army of dollar bills to work for you. The idea is if you put $1 in, eventually you want that dollar to make you the next dollar and not your time. This is what people call as passive income, a very wrongly construed word or term, but we'll kind of move on from that. So investing is putting your money into a vehicle that will make money on its own and eventually do what's called compounding interest, which means your money that made you money makes you money. And that is the most beautiful thing in the world we live in today, and that will be what allows you to retire early. Even if you're making $15 an hour, if you start doing this at a young enough age, you will retire a millionaire. Before we talk about what kind of investments there are out in this world and what's an available investment to you guys, let's talk about what kind of investor are you for a second, and this is all about risk tolerance. So there are basically three types of investors. There is a very risk-adverse investor, so somebody that wants to be extremely conservative with their money. Typically that person is going to invest in bonds and things similar to bonds, so low yield but low risk. You have your moderate investor who's going to try to diversify as much as they can. They're going to balance bonds, real estate, stocks, less traditional investments like investing in startup companies. While that's still risky, it is a good, total portfolio, total exposure approach. And then you have your more aggressive investor that might, let's say, and now I'm not saying YOLO your money into some no-name crypto, but that more aggressive investor might be investing in individual stocks versus index funds or broad market ETFs. And don't worry, I'll talk about what all those things are. Basically, my recommendation is always be the more aggressive investor unless you're in a later stage of life. And if you're in a later stage of life, be that moderate investor. I rarely recommend being that conservative investor. That is for a very specific, unique type of person. But fortunately, because of the YouTube algorithm and just YouTube in general, you guys aren't that grouping of people, likely. Statistically, you're not. So my recommendation would be don't go YOLO and uneducatedly invest in individual stocks. But as I talk more through it, I always propose increasing your risk for reward, especially when you're younger and you can take that hit, especially when you're only investing $1,000. Let's talk about it. We're going to briefly go over the different types of investments. So the first investment is a stock. This is what everybody talks about when they think about traditional investing. They think about the stock market, investing in stocks. What is a stock? A stock is a portion of ownership in a company, right? So if I buy a share or a stock of Google, I'm buying a very, very small allotment of Google, which entitles me to benefits if they grow. Google is a bad example in that they don't give dividends, but let's look at AT&T. If I were to own a stock of AT&T, every quarter that they profit, they cut me a dividend because that's a dividend yield stock, which means I get a percentage of their profits. It's very small, but something that's paid out to me. I also benefit that as AT&T grows in value, as they're more profitable, as they increase their assets, as they grow in value, their stock grows in value, I also make money that way. Then you have bonds. Bonds are very, very low risk and low reward. They don't have a high rate of reward. Basically what a bond is, it's like a reverse loan. You're essentially loaning money to the government, back to the government or to a corporation or company, and they're paying you interest on that money that you've loaned to them. And like loans are low interest for the most part. So your money is very safe because you're investing it in either into the US government, which is backed by the Treasury, or into a company, which is backed by the company's wealth. And therefore, it's kind of like a guaranteed return on your money. And it's not guaranteed. Nothing's guaranteed in this world. But again, low risk, but low reward. And then you have mutual funds, index funds, ETFs, which are all bundled investments that track broader markets. So like a great example, what does that mean? They could be like an index fund that tracks the S&P 500. The S&P 500 is the group of the top 500 stocks in the US economy, in the US stock market, and an index fund would track all 500 of those companies, so you have a more balanced range of the top 500. You could have a total stock market ETF, let's say. Now that is a managed fund from, let's say, a Vanguard ETF that's total stock market, and then it will track the entire stock market and how it's doing. Now, what are the advantages of something like that? Well, you're exposed to more companies, so if one company fails, let's say Nike goes belly up, probably not going to happen, but if Nike goes belly up, you're probably going to be okay because you're tracking all of the stocks and you don't just have an investment in Nike. And then your last two types of traditional investing is going to be real estate, both physical and what's called a REIT. A REIT is when you give someone else your money. You can buy it on Robinhood, or you can buy REITs pretty much anywhere, any kind of brokerage, but it's where you give someone else your money to then invest in real estate, broker deals, own real estate, rent it out, and you get typically a high dividend yield, and if they grow, you grow like a stock. Or you can buy physical real estate. I am sitting right now in what is a flip for myself. I bought this, it's a gut renovation. My hope is to renovate it, rent it out to a tenant, repeat the process. So I'm trying to invest in the stock market as well as in physical real estate. That gives me a little bit of diversification, and this is what I know, from a physical, these are where some of my trade skills are. So now that you know a little bit about what you can invest in, what the traditional investments are, what are your options, where would I, because this is not financial advice, where would I put my first $1,000 if I was just getting into the stock market in 2022? This is the coveted question, and everybody seems to have a different answer. But the reality is, everybody that is trying to make money off you is telling you to YOLO it. I promise you. Or they're trying to get views or garner fame or whatever. Your first $1,000 should be a relatively aggressive investment. And I'm not saying throw it at the wall and see what sticks. I'm saying you want to pick something that is going to have some high returns, because $1,000 isn't a lot of money in the grand scheme of things. And if you get it into an investment that is got some level of safety but has a higher return on your money, you're going to have a higher long-term outlook. And we're investing this money to set it and forget it. Now that's the key term. For your first $1,000, it needs to be something where you can set it and forget it, so you can start learning and understanding the stock market. Even if you don't want to and you're like, I want to set it and forget it and never be part of it anymore, it's not going to carry you through life. So if you want to retire early, you want to have some financial freedom, you need to at least start to understand over the next 20 years things about investing, about personal finance. And at the start, don't wait. At the start, let's put it into something that is set it and forget it. So if I were to invest my first $1,000, I would open up a free brokerage, a free trading brokerage like Robinhood or WeBull, and I would buy VTI or VOO. These are Vanguard ETFs that track the total stock market and the S&P 500. Historically, they've had really, really good yields. In fact, they've had incredible yields. If you invested $10,000 in like 2012, by now your money would have quadrupled. You know what I mean? If you track the S&P 500, if you invested $10,000 in 2012, you'd have like $44,000 now, which is an incredible yield. I mean, that is way above the stock market average. There is some risk here. Obviously, the S&P 500 is very tech heavy. If tech doesn't do well, it will drop. But the thing is here is we're setting it and forgetting it, and we're leaving it. This shouldn't be money that we need to draw from immediately or draw from in the next year. This should be money that we're putting in there with the intent to leave it in there for 5 to 10 years at the minimum. So that's what I would do. It's very simple. If you guys need more help on how to exactly do that, open up a Robinhood, actually invest that money, let me know in the comment section below. But yes, that's what I would do with my money if I was investing my first chunk of change in 2022 in today's market, in today's bear market. Yes, a recession could come. I'm not trying to fearmonger. That's just the probability of what we're looking at. A lot of financial institutions are saying that's very likely. So broad market ETFs, index funds, mutual funds. Not a huge fan of mutual funds, but it is what it is. We won't get into it. Those are going to be your best options for protecting your money during the downturn, but still giving you the upside of having a larger return on your money. Again, long term, you might not see any gains in 2022 or 2023. We're going to be in a bear market for some time, but if you get your money in now, time in the market is always better than timing the market. I hope you guys enjoyed the video. If you enjoyed the content or you learned anything here, give me a like, throw a comment in the comment section below. I will answer all of you guys. Thank you. I appreciate it. Have a great day.